your short-term and long-term trades differ, and how do you determine your stop placements?
On the stock market, I do my best to try and get in on a pullback using the Fibonacci patterns that I talked about. However, if the fundamentals are really good, then I can get away on the stock market with buying some breakouts of triangles, ascending triangles, etc. Because the fundamentals are behind the share, and it normally breaks out quite nicely. For example, TriFast, a relatively small little company, it broke an ascending triangle and it's up 50 or 60% in the last 6 months. It just kept on going. That rarely happens in the more competitive markets. So in the more competitive markets, Forex market and indices, I would rarely buy a breakout. Because one, you haven't got the fundamentals telling you that this thing is going to push. And in fact, if anything, most of the breakouts that happen in the Forex market are actually false breakouts. So that would be the only difference in stocks, because I've got and measured the fundamentals, and I only get involved in shares with really good fundamentals, then I'm quite happy to buy a breakout in the direction of the trend in sync with those fundamentals when the general market is rising. A lot of boxes to tick there. And if you tick all those boxes, most of the trades work, 75% of the trades work. In the Forex market, much fewer boxes to tick, no fundamentals, and lots and lots of noise around, and there I wanted to buy into a trend only on a pullback at a very good level. And if I had more discipline, I'm still working on it. The first 30 years is the worst, they say. I'm still working on it. Then I would only trade those Gartley patterns. But yesterday, that upspring was really good.
How would you determine your trade target?
On the stock market, I invariably use a trailing stop loss, which is in fact defined by the average true range that we talked about a moment ago. On the Forex market, and I'll be looking at Fibonacci extensions from the pullback. So very simply, most software does it automatically these days. You just look at the pullback, and you multiply the pullback by 1.618 and you add it to the low. If you're feeling particularly brave, you look at the pullback, multiply by 2.618, add it to the low. And if you're feeling really brave, you look at the pullback and multiply it by 4.23 and add it to the low. 1.618 times 1.618 is 2.618. And 1.618 times 1.618 times 1.618 is 4.23. Okay, those are the Fibonacci extension levels along the way. And that copper trade that I talked about went to that 4.23, just kept on going.
What about the average true range? Do you ever trade using that?
The average true range I use to calculate a trailing stop loss. And I also use it to calculate the initial stop loss. On VectorVest, we have an average true range based stop loss. The average true range just pretty much says that there are shares that are more volatile than others. And it's a mathematical way of, in fact, being able to put your stop well out of the traffic so the normal ups and downs of the market won't take you out. It's so easy to die in a sea of stop losses. So it does its best to try have a fine line between not risking too much cash, but at the same time putting your stop well out of the traffic so you don't get needlessly stopped out.